Welcome back to another edition of the Aria Finance Specialist Scoop. I'm lucky enough to be joined for this episode by Gavin Seaholme, the Sales Director at Shawbrook Bank. Gavin?
Hi Joe, thanks for having me.
Yeah, thanks for coming, mate. So we as a business have worked with Shawbrook for many, many years and with Gav personally as well. So Gav, do you want to just explain a bit about yourself, how your role at Shawbrook, how long you've been there and what sort of led you to this position?
Yeah, so I've been in the specialist industry for over 20 years, working with broker partners. Been at Shawbrook circa over 10 years now, so I've seen the kind of trajectory and the growth. Worked in everything from collections, underwriting, through to sort of relationships, and then sort of to what we're doing now with you guys. Yeah, so
Man about town.
something like that. I started when I was 4.
Yeah, of course, yeah. The Shawbrook has changed massively in the time that I've been working with you as a bank and we as a firm have. The profile of the business is drastically different. How big a proposition now is Shawbrook Bank?
I think it was in the early stages. It was obviously challenging the norm, and hence the phrase challenger bank, right? But as we've grown, kind of moved away from that. Balance sheet's big, circa coming up to 20 billion now. Other brands within Shawbrook, as you're aware of, funding other institutions as well, and it's just growing. And what we've done is we've actually been able to grow as this industry's grown. So as landlords have grown, as property investors have grown, as the needs of them has grown, we've been able to grow with that as well. But there's other areas to the bank, as you know, within sort of SME, and the deposit side is a big thing, which helps secure our funding.
Yeah.
So we don't have to rely on the capital markets per se.
Yeah, I mean, you're lucky that you're so diverse in your operational running as well, that you're safe and you're protected and you're a great lending institution. From the real estate point of view, in terms of property finance, what's the evolution been like in the last 3 to 5 years, in a post-COVID world? How have you seen that change tonally inside the bank?
I think it was always easy to get onto buy-to-let, right? Because the returns were good for investors and lenders, because funding was cheap, probably abnormal, as we know. And then when COVID hit and rates have moved around, you've seen that our offering, where we always done commercial and bridging and so on, you've seen more investors move into that space and utilise that funding more. So the traditional buy-to-let is still strong, still popular. We were always specialist, HMOs, more portfolio-led. But when you see the investors now really diversifying their portfolio, you can see that our product suite kind of complements that. But we're always kind of trying to innovate, because investors are always 6 to 12 months ahead of you from a lending perspective. So you're kind of always trying to catch up to make sure you're funding what their next sort of thing is that they're looking to do.
I think that the supply and demand piece is really interesting, because one of my biggest things that I enjoy within specialist lending is the borrowing market is super agile and really resilient, and always finding whenever they're squeezed in one area, they're trying to find opportunity in another. And the best lenders are those that also react to that as well and trying to find ways of funding that. You're lucky that you were one of the few banks that had a true bridge to let proposition for a while, which is still there, right? You're still one of the few that are supporting that market for the whole customer journey.
Yeah, correct. I think it's trying to retain a customer, support them on their journey, and the bridge to let is a good example of that. But I think also the fact that we are a specialist lender, we have a diverse sort of product offering, which complements not only borrowers, but also what you can offer for your clients as well. And I think over the years it has changed. We were heavily into trading business, we were heavily into sort of buy-to-let, we were heavily into commercial. And kind of everything's now important to us and our investors and our clients. There's not one specific thing where, right, we're going to all go into that area. Because of the diversification that we see from landlords, everyone's moving into different sectors, and that's where we try and support.
I think I know the answer to this from what we see as a brokerage, but I'm keen to understand what do you see? What have you seen a rise in when borrowers are chasing yield? What are you seeing more of now that you weren't, say, 2 years ago?
Yeah, I think it's an evolution, right? Buy-to-let, HMOs then into sort of larger HMOs, create and add the value in the HMOs or whatever it might be. Mixed use is coming big, semi-commercial, so commercial unit downstairs, maybe create something in the space above. Commercial is good with regards to a long lease and so on, so you get the certainty of that. You could split the title if you wanted to, so you could split out resi and commercial. And then just full commercial as well. We're seeing a lot more people move into that space. But it's all about yield, right? And as mortgage rates continue to be normal, and then yields get squeezed, different regulation, tax and so on, you want to be able to support the landlords with your offering, but they'll always chase yield. It might be third-party leases, for example, looking at vulnerable tenancies. There's lots going on out there at the moment.
That the vulnerable tenancies is interesting because the hot the hot topics from our side that we see talked about a lot, particularly on social media, and it's not always brilliant advice. It's a bit get rich quick type, but you see a lot of rent to rent stuff as well. But one of the ones we see more in the debt space is that social housing piece. And it's funny for me as a broker now going and doing the rounds and hearing so many people pitch this model and talk about it. And the fact that lending is there. Actually, 5 years ago, there was one lender, maybe two, that were doing those Serco type social housing contracts. And it was Shawbrook, right? And you're still in that space now, and that's still a market you can support as well, right?
Yeah, we look at it. The leases are hard because there's lots of caveats in there. Some are probably more pro to the leasing company rather than the lender per se. But I think it's a good way of maximising yield. There's, again, supply and demand. You touched on it earlier. A lot of local authorities need to use the private rental sector to support not only asylum, but also just vulnerable people in general. Now, vulnerable is a very broad brush, right?
Yeah.
So it could be, I'm not going to go into the finer details of what vulnerability is, but there's a broad brush. There's a demand for it. I think there will be more people looking at the actual leases behind it. Depends how you fund, whether you securitise and so on. But if you look at the fact that they maximise the yields, but don't think you're going to get the value based on those yields as well, I suppose is one way of trying to manage expectations, you know. Just because you might get a 20-25% uplift in your rents doesn't mean you're going to get that in the value.
Yeah, makes sense. I mean, as with anything, particularly stuff that's new, there's an element of risk and uncertainty and finding your feet with it. You know, we're still in the infancy stage of those type of products and those type of strategies. One of the evolutions that we've seen with landlords is you talked about, and you're right, I think, the evolution of asset class people are willing to take on. So that move from standard single family let AST to HMO and commercial and semi-commercial. But we're also seeing loads of people being brave enough to convert and actually to chase yield with adding the value themselves and undertaking that project. And from the bank's perspective, you know, you guys have real appetite to support that market too, right?
Yeah, I mean, we're seeing a lot of it, get a lot of demand for it. There's a lot of units where, you know, blue chip tenants are kind of not the in thing for lenders anymore. If you looked at the high street years ago and someone said, I want Woolworths, Debenhams, you'd rip your hand off as a covenant. Now you're probably better off with just more secondary kind of tenancy. So you'd have a smaller firm, might be a coffee shop, might be a bit more lifestyle driven, but there's a lot of space above these units. So if you can get into that space and create that value, and then obviously it'd be HMOs, flats, maybe go up a floor, go out the back, extend it.
Yeah.
And once you create that value, you've got the surety of the commercial, and you've also got the income coming from the residential as well. So it's a good mix, and I think it's a good way of diversifying for people to spread your risk as well. I don't think commercial doing that per se is as scary as people might think.
Yeah,
it's kind of not too dissimilar really to a buy-to-let. It's just a lease rather than a tenancy agreement.
Yeah. I think that that diversification across the board is so important, and it's something that we do quite a lot of education about with landlords when they're saying margins are tight and we're struggling. Well, if you diversify, you cover yourself one way or another. Things ebb and flow and rise and fall, and covering yourself is a good thing. From the bank's perspective, supporting borrowers getting into that, what sort of experience do you look for? How can you help when someone is experienced, repeat borrowers? Can you gear up on some of these funding? Where does Shawbrook stand out for actually supporting borrowers looking to diversify into new areas and add value?
Yeah, I think it's around making sure they can get the gear in for a start, because obviously, you know, it's all about trying to get the gear in to make the project work. Either get your money out if you put money in, making sure you can maximise the potential sort of the asset as well. I think we support that well with what we do. I think when you look at commercial, yes, it is more complex than residential. We look for experience. Maybe have you got the same asset before? Have you got a few buy-to-lets in the background? We're seeing that diversification move over, so you can understand that. Yes, it's a different. Have you been through break clauses, for example? Have you had to renegotiate leases? That's the kind of stuff you look for. But overall, we're kind of really trying to make sure we just support that change, that diversification, and then we're seeing a lot more of it. A lot more of it. And it's interesting, you talked about networking and seeing people. A lot more people are talking about it now than they probably were 5 10 years ago.
Massively. Yeah. Loads of noise around it, and lots of noise around, you know, the taglines, BRR, you know, all this sort of stuff. It's everywhere. And people are, I think, keener to try it and braver and less reticent around something new and scary. And that's partly because there's so much support from lending institutions and banks now, and actually leveraging it. You guys have got a great product where you'll gear up for a light refurbishment, right? Do you want to just talk that through as well?
Yeah, we basically will lend on the day one purchase of 75%, and then let you be able to raise up to 85% on the funding as well. So it's like a light refurb. So you can create HMOs from it and so on. Nothing structural. Again, it's just that extra bit of support that we look for, because stamp duty, costs, legals, everything bundled together does cost a lot, right? So you want to cost of materials. The cost of things have gone up exponentially quite a lot over the last few years, especially for these sort of projects. So you just kind of want to try and get in and help support people as much as you can, and then hopefully you can then look at the end product and go, do you know what, here's a long-term solution to, like you spoke about earlier, around the kind of bridge to let. And that's something we're really keen on. Retaining clients is a big thing of ours.
Yeah, and you've always been good for that, incentives and good communication, and people like to borrow from a strong name and safe money. In a volatile market, safe money carries its weight in gold, so it's a really good thing. The diversification of smaller, newer professional landlords, ambitious landlords on their growth journey is one thing, but we as a business, and we shout about it online a lot, are really active in the large loan space. We see a lot of high net worth borrowers. You as a bank deliver a lot of these facilities, but you've had changes recently and enhanced your proposition for that market, which we felt with great success. What changes have you made internally, and how do you sort of look at those deals a little bit differently?
So it was an interesting one, because we looked at our business and we saw that we do write large loans, we always have done, but we've got a great digital proposition, right, as you well know, and you can go into our portal and you can get great outcomes and so on. If you put a £500,000 deal through that, it's great. You try and put a £15 million deal through it, it's this great journey at the beginning, and it's kind of just something like that is different. There'd be more nuance, they'd need a bit more expertise. So we decided to create this special structured real estate team, which you've dealt with. And that's just a different journey. It's a concierge journey, but with some real smart people that actually understand the fundamentals. It's a different beast to what would be a £500,000 loans compared to a £20-30 million loan. And the guys internally have built their own teams out. They're actually in pods now as well. They've got business analysts that work with them, and they just structure the deals. They go directly into credit, so they'd be able to present that. They'll meet the client as you saw, the asset, etc., and they just structure it. Takes a little bit longer sometimes, but that it's rubber stamped day one from that point, which is, I think, is a real, from a broker's perspective, that's all you want, right?
And I think there's probably a myth and a misconception out there, because a lot of people that are going to watch this are on their way, on their journey, or have their ambitions set on being that 20-30 million pound landlord, developer, investor with a portfolio and with finance opportunities that scale those sort of heights. And I think the misconception is you have loads of money, everything's much easier. Whereas actually, it's funny, the large loans that we've seen over the years generally carry the more complexities and moments of difficulty and challenges, because it might not be an off-the-shelf product that suits, and it might be that the assets need a different form of evaluation and looking at. And so the creation of a bespoke team is no bad thing. What's the sort of criteria that gets a case falling into your SRE team? What gets them looking at these?
So it's 5 million plus. Traditionally, they'll look at that, and they'll go up to anything to sort of 30, 40, 50 million now. I think you touched on it there. There's always, it's not more nuanced. I think it's just more complex, and there's a reason for that, right? Because it's a large amount to borrow, and it might be structures. It could be some offshore element. It might be some different ownership structures, a bit more layered. Might be the assets as well, right? The one we done for yourselves would have been a traditional asset that we probably would have considered.
And I think that's a really good segue into, we've had a landmark completion this year, a real success story of the SRE team, and the work that's gone in on a complex case. But that was, for those listening, that was a commercial asset with listed elements of the building in city centre in Scotland being demolished. There's an acquisition element, a demolishing element, and actually through getting your guys looking at that sensibly at day one and understanding the value in the location, the value in the asset, and the sort of longevity of that project, it enabled you to gear up and leverage that debt in a way that honestly no other lender in the market would have touched. And I did look at other options, of course, at the time, but it was the most aggressive foot forward that I think the market could have given to a good borrower and a great asset. But it was a real success story, and it totaled a £31 million loan with an element of that as a VAT bridge as well to cover some VAT they had to pay. So it was a landmark win, right?
Yeah, I think if you'd have presented that to us before the SRE team a couple of years ago, I think if you'd have picked the phone up to me and run it past me, I would have politely told you that it's not one for us.
Yeah.
But I think that's the beauty of that team, right? the expertise, the way you can structure it, think outside the box. Even the product can be fluid as well in its approach for what the clients. It's not a homogenized, sort of Big Mac. This is bespoke pricing, bespoke products, bespoke tailoring for what the customer needs. And then the more you talk about that deal, the more I think I still can't believe we've done it. When you mention everything that you just went through, but it just shows you the power of an SRE team that they have there. And we're not going to do everything, right? There's stuff that we just can't do, and we're not afraid to admit that to our brokers, right? Because there's stuff that we just can't fundamentally do. But I'm really, really pleased with the journey that team's been, over a year now, and the journey they've been on and what they've created and the way they can work closely with credit and get the buy-in. And some of this stuff has to go higher up as well, and it's a credit to their team and also our partners to work closely with them and get the solution for the customer, right?
Because obviously part of the joy of working in this environment, and it's not just lenders and brokers and everybody in the sort of financial sector, it's borrowers as well, is when you're touching into specialist property, specialist lending, is that we all sort of live and work and operate in the grey area, and black and white products don't really exist for this market. If you're looking to do things that are a bit creative and aggressive and make money from property, it probably doesn't fit with a high street bank where it's off the shelf and it's nice and easy on the conveyor belt. But that stance is something that you can take into smaller loans as well, to larger loans. That's a sentiment that's shared with the bank, right?
Yeah, it's definitely it's pretty much how it evolved, really, right? To fill the void that where others didn't tread, i.e. like the high street and so on. And I think as it's moved forward, that we have what we call a flow offering, which is in that sort of arena which talks about the smaller value loans up to sort of £5 million, and then 5 million plus they move into the sort of more specialist structured real estate team. And actually, do you know what? That grey area is an area where you can structure, you can use that, and you can use it to your advantage as well, because actually sometimes black and white is good, but it doesn't tell you the whole story. So at least if you get an area where you can look at asset, customer, everything that goes with it, then the grey probably doesn't seem as scary as it should be.
Yeah.
But what it does do, it creates an opportunity, not just for ourselves, but for a customer to then leverage, to then be able to move on and support them on their growth and their journey.
Yeah.
And that's important, right?
Yeah, for sure. And that grey can fall into the, first-time landlord, newer borrower space, which isn't typically one that Shawbrook has always loved, looking for a bit of experience. But when people have got industry-adjacent experience, those are the type of conversations where we can take a view, right? Experienced developer working for someone else, taking on a first project. We can have those chats with a bank like yourself and look to support a good borrowers still, right?
Yeah, exactly. I think we've got a bit more kind of savvy around our experience as well, because exactly what you've touched on. There'll be people that might not have undertaken these projects but have supported other people. We're a bit more lenient with regards to our experience going forward now. I think it's just a natural evolution of when you see people just don't go into a 3-bed semi buy-to-let anymore. People go straight into a HMO.
Yeah.
People will go straight into commercial property.
Yeah.
Because the dinner party landlord of the 3, 4, 5 buy-to-lets where rates were cheap and it was a nice sort of passive additional income, that's really squeezed. So you need to, you touched on it earlier, to go after that yield, you probably need to kind of get your big boy shoes on and go into that sort of arena where you are getting the yields.
And people are braver. People, as a fact, are braver. People are going for
and it's products as well. Products are a lot more wider. I mean, when we first started, HMOs was kind of very embryonic. We helped with the RICS valuation. We helped understand yield-based valuations and so on. A lot of people do that now, right?
Well, I was literally about to ask you, we've got a future episode coming up with a notable valuer in the space. But one of the big things is, and the danger is that newer consumers to the market are maybe going on courses and hearing all about commercial valuations. You need a commercial val on your HMO. Now, you are a bank that will look at yield-based valuations on HMOs, but that's not for everything. That's not for everyone. You can't buy a 4-bed HMO and just expect an investment value. Well, how do you assess that? What can a borrower do to make a property more attractive in your eyes as a bank to secure a higher valuation?
I think it's a case of looking at the property and going, right, how much does it take to convert it? What do you convert it into? What's the planning look like? So, C4, moving into Sugen and so on. Will it ever go back to a residential house? So, if you're doing a small HMO where you're putting a few stud walls up, maybe not en suited, but, just kind of reconfiguring internally, then the reality is you'll probably get a bricks and mortar valuation on that, right? Because it won't take much to just reconfigure it back into a 3-4 bed house, for example. If you're creating a larger HMO, where fundamentally the footprint will be just literally a HMO. It's never going to be anything else.
Yeah.
It's hard because comparables aren't in the market, because when someone does create a very good HMO, they don't sell them.
Yeah.
So there's always that. But actually, if you look at the whole sort of structure of what it looks like, what planning it has, if it's an Article 4 and things like that, and you put it all together and you go, actually, do you know what, that makes sense to evaluate on a commercial valuation, because it will never go back to being a residential property. I suppose that's probably as basic as you can try and put it. I think the yield-based approach, well, I'll just times it by 10 and so on. I think that's a little bit finger in the air, and people need to realise that just because you're putting your rents up doesn't mean your property value goes up and so on as well. But overall, we think we found a good place. We kind of have that bricks and mortar, the hybrid kind of valuation where we might take a little bit of an into element, and then obviously the full commercial. And we find a lot of our customers use the commercial valuation because they've added the value. They've probably done the refurb themselves. Yeah. They've probably done the transition from the house to the HMO. And it might have been commercial before, for example, and they've turned it into a HMO and things like that. So we're seeing quite a lot, old pubs and things that you see now.
Yeah, stuff that isn't necessarily going to ever go back to a residential valuation because it's not an owner-occupied house. Yeah, and I think that's really good for people to hear and to learn, because again, there's a bit of misinformation in the market that you should just go to a lender that will give you a commercial val, but that's not really a thing. It's about the asset and the work that you've done, and it plays nicely into the hands of the professional landlord. And we talk a lot about the rise of the professional landlords and how the entire ecosystem around that is growing. But we've talked on previous podcasts where within a professional landlord environment, lenders are keener to lend to those borrowers, and that's more attractive to you guys as well, right?
Yeah, I think just to touch on the yield-based commercial valuation is always a good question to ask a customer. Would you pay that for it? Now, if they say no, then you kind of answer your own question, right? Because that's how much the property is going to be worth. If they're not prepared to pay for that, then you realise that. But that's the smart investors, and that goes to your next point, right? Investors we want to support them. We look at putting in place umbrella limits so we can have credit back terms that, I'm not saying we've just got an open checkbook, but we've got credit back terms that will say we can go up to a certain level of borrowing, and then we can extend that and keep moving forward. We like that journey. We like meeting our customers. We're not faceless with regards to a bank situation. The team, like me, we've got a team of portfolio managers. We've everyone involved likes to support the customers move on. And also, you'll see on that journey, you see them change. You see them pivot. And that's always quite a good thing as well, knowing that you've supported them throughout that journey. Yeah, it's quite a nice thing to see. And some people are quite happy just staying in their lane. Some people are quite happy with just buy-to-let. But you can't knock someone if they've got 50 to 100 buy-to-lets, right? They've done something well.
Yeah.
But you do see a lot more diversification now. And retention is key for us.
Which makes perfect sense because of trusted borrower who's delivered well. And I think that's the thing that new entrants to the market need to make sure that they keep at the forefront of their priority list, looking after their debt, looking after their credit commitments, and good borrowing behavior, because that leads to a smoother transition next time, a smoother transaction and a better process, and ultimately more borrowing and quicker growth, right?
Yeah, I think there's always going to be a few bumps in the road, especially if you own multiple properties. Tenants might not pay certain things and so on. But yeah, keeping on top of everything. Small things, making sure if you're using a managing agent, make sure they're the right management agent and they've got the right sort of nous and expertise in the area. But I think once you get that sort of power team around you and then you can grow, you want to support these people and you want them to grow and you want them to see them go from 2 million, 3 million, 4, 5, 10, 20s and so on. You're also seeing that the high street are kind of shying away from that kind of more, it ebbs and flows, don't get me wrong, but the high street will come in and offer very, very good levels of rates and so on, but they can't get to the leverage that someone needs for their model to keep growing. And that's where people like ourselves and others will come in and fill the void, right?
The high street have a low risk appetite, right? And they always will do. That's their job. That's their right. They have a lower margin. They make less money on their products, so they don't have to take on stuff with a risk. Whereas the challenger banks, specialist lenders, you pay a certain price for leverage and for support, where others wouldn't give it to you. Interest rate is an interesting one, and the big awful question really is, what's going to happen? What do we think? That's what everyone wants to know. Is it going to be affordable down the line? Is it going to get better? What are your thoughts on the current interest rate environment and the next 12 to 24 months?
I think as we touched on at the beginning, we've been doing this for quite some time, and the last sort of when it was benign for quite that while, they weren't normal. A lot of people dived into buy-to-let because it was a good investment because savings accounts weren't giving you the return. You get a good appreciation on an asset, all the stuff that we know about. Rates have kind of gone to a level where people weren't expecting them to go or weren't used to it. Some people have never seen rates in that period. I'm lucky enough to be old enough to realise that. But I think now we're seeing a more, what I would say, more normal kind of playing field of what people should be used to, which will impact their model and their cash flow. The base rate dependent on a lot of factors in the world at the moment going on, and figures and inflation and everything that moves around it. There was talk that there probably might be another cut, but who knows? Some of the recent figures that have come out might stall that. But realistically, I think it's kind of normal now. And I think people need to get used to it, to be perfectly frank. I think people need to get used to it, but people will get used to it and maximise it. I think it's harder because tax has obviously changed the sort of landscape for people. More regulations coming in, which is cost. Projects cost more. So actually the kind of reward out of these investments is hard, but then you've got to look at, how long you're going to do it for. That's the key to it, right? And if you'll be in it for a while and you're going to be able to maximise that asset value and sweat that asset value over time, and then you'll be fine, and you'll get the ascendancy of the value, as well as probably not as much cash flow, but a good enough cash flow. All the banks stress, as you're well aware, on rates and so on. So there is enough sort of in that yield and that cash flow to do it. But it's been a very difficult period for everyone. But I do think this is normal now.
Yeah, and I'd echo that completely. I think that's a great answer because and there's two things that you touched on there which I really like. One is the sort of implication that property is a longer game. And that's my view personally. But as a firm, we see, our most successful borrowers and long-term clients have been in it a long time, are willing to sit on an asset when it's not quite right, but it's still profitable, and play the long game, find our way of translating that or transferring it into a different asset class or upscaling and somehow making that better. But the commitment to buy-to-let is sort of the key for a long-term portfolio landlord. And at that point, the rate matters less. With it being the new normal now, if a deal works for a borrower, they should be taking it, right? Because if it works now, in theory, it's only going to get a little bit better and you'll see better yield in the future as well.
I think there's a couple of things. Depends on what you're after. So if you're purchasing, then I think it's probably a good time to just be part of the norm and carry on. 25 bips here and there on a rate isn't. If you're on a variable rate and you're sitting on 6s and 7s and you're still riding that out, I think that's a point where you have to come and speak to a broker like yourself and go, look, I probably need to do something now, because I think everyone's been expecting this dramatic shift downwards, and it kind of hasn't happened, and swap rates are quite volatile still, moving up and down. So you can see that actually people that are probably not procrastinating but are probably just sitting and waiting probably need to start doing something about that, because the cost of sitting on that variable will probably outweigh the 25, 30, 40 bips they're going to try and save in 6 months' time. So you have to balance it out. And that's where, working with specialist partners like yourself and brokers, they need to get that professional advice, right?
I think the market is getting more awake and aware and savvy for the fact that it's not going to drop overnight.
Yeah.
I remember that January, February, the event rounds that I would go to following the mini budget in the September 22. So the early year 23, I would go and I would meet consumers and borrowers, and they would tell me, I'm just going to hold fire, rates are coming down. And I'd say, when? So next month, rates are going to come back down. This won't last long, they'll come down. And we were sort of, the whole of the financial services industry was going, this is the long haul, right? It's not, as much as it's a mountain, it's not a triangular peak, it's Table Mountain. We're going to live at the top for a while, and we're going to have to get used to it and find opportunities that work still. Good landlords, I think, found ways around that, and agile and resilient and look for
probably
opportunity.
Experienced as well, right?
Experience is a good one, or open to listening to good ideas and following the right people.
Yeah.
But it is a slow decline, and actually we've seen a rate decline over the last 18 months to a position that is normal. It'll be interesting to see what happens from here. What do you as a bank think the next wave of investment looks like? Where's the next point of focus for borrowers, do you think?
I think that it's a really good question, because they're always ahead of what you can offer. I do think commercial will continue to grow. I think we've really opened our appetite into sort of SME trading business as well. Mm-hmm. I think that's an area where we can see some good growth as well. I think also you probably need to look at the fact, as customers and investors diversify, they're probably looking at quirkier assets. So there's probably an element of where you looked at, we talked about the SRE deal, but they're probably on a smaller scale. There'll be assets that you probably wouldn't traditionally look at that you maybe have to probably take a bit more of a risk-based approach on and go, actually, yeah, it might be this at the moment, but it could end up at this. So let's sort of help support that. So I can see probably diversification, as we talked about, commercial will continue to grow, trading business, owner-occupied, that will continue. I think there's a lot more entrepreneurial people, SMEs seem to be growing, especially in this space. And then I think there'll be an element of really trying to add value. So that will be buying maybe distressed assets. People might be, you talked about it earlier, people have been doing this a long time. It might be time for them to start moving out and cashing in, getting the pension, so to speak.
Yeah.
The property pension, as we like to call it. Because you've probably refinanced that portfolio 3, 4, 5 times. You've done all right from leverage point of view, so maybe it's time to look at that. And also I think there'll just be an opportunity for larger portfolios where people are looking at changing ownerships and succession planning and things like that because of the way that some of these portfolios are structured. I think people need to look at that and go, actually, probably with the advice from their accountants and their tax advisor, we'll probably have to look at things and go, actually, you're probably from an IHT perspective and everything, we probably need to look at some of these larger portfolios and change structures.
And the portfolio thing is interesting because that angle, which is quite right, is looking at how does a portfolio look as it's coming to maturity or somebody's towards the end of their property career and how do they structure that in the right way. But if you've got ambitious property professionals, landlords who are buying maybe quickly, who are growing quickly because they're transacting well and they're adding value and they're remortgaging sensibly, at what point do you think somebody, and conscious that advice is bespoke and individual, but at what point could somebody start looking at a portfolio product, one loan against multiple assets, and what are some of the benefits of doing that versus individually remortgaging?
Yeah, I think there's 2 schools to it. So you can do one overarching loan, and you could have different subsidiaries, but have a hold co that you could probably take the whole charge over, or things like a revolving credit facility, which is something that is on the drawing board for us, for example, where you can dip in, use the equity you have, add in different sort of assets and move it and be a bit fluid like that. So that's something. But overall, it just depends on the structure, right? But I think definitely a revolving credit facility would be, if I had a product wish list, and also if I was a customer, that is definitely something that I'd be keen to explore and have. You know, you've got 100 properties, you've got a charge on them, you're probably leveraged not as highly across all of it. You've got eyes on the whole portfolio, not all of it, might be some. Might be one structure, but there's other stuff in the background in different structures. But you've got that, and a customer knows they've got that surety of going, actually, I want to dip into this now, or I want to stand still, and I want to I'll use it when I want to use it and take advantage of it when I want to take advantage of it. So I think that for me would be one of the areas. Probably a question for you. What do you think?
I mean, revolving credit is fantastic, and it works before we both get bombarded with messages for revolving credit facilities. It's people with assets with equity in them, right? Yeah. It's actually, you're sat on money, and what you don't want to do is pull it out right now because you're not sure where you're going to deploy it, but you have it and you want to leverage it later, a bit like a cash machine. You keep pulling your equity out, investing it elsewhere, paying debt down, rinse and repeat. That works when you're established, when you have a portfolio, when you are at a lower gearing. I think it's a really fantastic option. I think beforehand, before you look at that, actually consolidating debts into one makes things easier from a valuing perspective, from a legal perspective. You have one direct debit, but it's a commitment to a portfolio as a singular unit for a 2 or 5 year period of time, depending on the fixed product you take. But it's a great option, I think, for aspiring, growing landlords who are happy with a set of properties, want to ring fence them, and then can pull their money out and move on and repeat. The growth for our side, I think, is that bridging space, short-term funding to buy assets, refurbish them, add value, do them up. And then people are, for the most part, retaining. I think there's still a commitment to long-term business where they're then remortgaging onto an attractive buy-to-let rate, pulling out their money again and going again. So that market is...
I think that's the traditional sort of profile that we see, and that's the profile we support really well.
Yeah, I think so too. And you're still seeing it, right? The market's still there for that model.
I think people are finding assets adding value, and that could be changing it completely. Now it could be like we talked about earlier. You could buy a pub and turn it into a HMO. It could be all sorts of myriad of things, but fundamentally buy at the right price. So people are buying at the right price. Still, there's some good people are getting to purchase at the right price. add the value, refinance, get the capital out, and rinse and repeat, and move again, and create that conveyor belt, like you said, and go again. And that's something that we see a lot of. And yeah, there's diversification, which we've talked about, but you can still do that model and diversify into different assets, but it's the same model.
Yeah.
So
In terms of the buy-to-let space being busy, there's a lot of doom-mongering in the market. Buy-to-let's dead. I hear that all the time. And I think, well, we're doing quite a lot of loans. I don't think it is dead.
Yeah.
As are you. Is buy-to-let dead?
I don't think it's dead. No, I think it's just it's probably dead if you were kind of, I'll be honest about myself, own a few buy-to-lets, and kind of it was a passive thing, secondary, bit of appreciation growth. And would I then go into 10, 15 properties, give up my day job and do it? I think that's probably a tougher gig now than before. But again, people are diversifying and adding value. But I don't think buy-to-let is dead, no, because there's a simple fact of supply and demand.
Yeah.
There is not enough rental properties for people out there, even in HMOs, and even larger sort of multi-unit freehold blocks and everything that people are trying to add value in. You're realising that fundamentally they probably will still carry on with buy-to-let as well. So you might buy a commercial over here and have a project going on, but you'll probably find they buy a couple of buy-to-lets as well at the same time. So
yeah,
no, I don't think it's dead. If it was dead, then I think we'd probably all be a bit worried. But no, I think it's just...
We wouldn't be recording this.
No, we wouldn't be. No, we would, but it'd be called the death of buy-to-let. But I think it's just more of a case of, it's not dead. Is it harder? Yes. Do you have to be more experienced? Not as experienced as probably, I'm saying 20 years worth, but just experiencing to understand the dynamics of a buy-to-let now. Mm-hmm. Before it was cheap money, let's be honest, you could 75%, you could go through from the high street all the way through to Challenger Bank. So I think at one point there was 3,000 buy-to-let products in the market.
Yeah.
So, that's quite a lot. And the growth from people, but there's still lenders out there. The more high street vanilla buy-to-let lenders have their niche in their area where they work in, and then you move across into the specialist lenders where structures are different, assets are different, but fundamentally it's still a buy-to-let.
Yeah, I agree. I think there's a market out there, and we're still seeing purchase transactions as well as remortgages, which you will be as well, right?
Yeah,
people
exactly
are buying
that.
still.
Yeah, it's people still buying and buying smart.
Yeah,
that's the way to do it. Buy at the right price.
Yeah.
And walk away if it's not the right deal. That for me is key as well.
So the patience is the key, right? When you have the asset, patience with it, interest rates, patience. If it's the wrong asset, don't just move because you got some money ready. Patience, and I think that sort of all leads to you making then a smart decision at the right time.
Yeah.
What sort of to wrap up, if you had to give somebody coming to Shawbrook looking for debt 2-3 key pieces of advice of what makes a good Shawbrook borrower, what's going to give them the best journey, the best chance of borrowing from you and borrowing at a good price and good debt, what does that look like?
I think first of all they need to choose the right partner. So working with brokers is key. So and that's not a sort of a project to make you feel special, but it's fundamental. I talked about it earlier, right? There's so many products out there. So making sure you're getting the right advice, speaking to the right people, making sure you know what you're doing. So I kind of call it like an MO. Make sure you got the right MO and stick to it.
Yeah.
And then we'll look to support you. And if you do diversify, then you know what? There's nothing better than someone like us at Shawbrook, where we will speak to you as a lender, we'll speak to you as a broker, and we'll understand that relationship and help them grow. I think it's growth is what we really like. We like that journey. We like supporting it. But fundamentally, as a customer, understand what you're doing, get the right people around you. And I mean, when I say right people, I mean broker. And I say this all the time, the power team part, broker, accountant, build team, everything around you. And then make sure you understand the numbers and you run it. And then you create that journey and that pathway of what you want to do. And there's nothing to say you can't diversify and move around, but actually just kind of stick with what you kind of start with and grow from there.
Yeah.
Try not to go too big too quick.
Yeah, great advice. It's making the right decisions, right?
Yeah.
All plays into making the right decisions. Well, look, that is super interesting, and thank you so much for joining us and coming and for the ongoing support as well. It's great. So thank you for tuning in. Thank you for watching or listening or however you're digesting this. Thanks again to Gavin and Shawbrook for joining us, and we'll see you next time.